Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. You're not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is October 19th. And Andy, I think I'd like to start off by reading a little one sentence from last week's EIA's release of their monthly oil outlook, the short-term energy outlook. And it goes like this, and then I want to hear your commentary. Potential petroleum supply disruptions and slower than expected crude oil production growth could lead to higher prices, while the possibility of slower than forecast economic growth may contribute to lower prices. What do you
Jim,
think?
that's a classic, and I think it's a classic that you and I have used often in our long and somewhat illustrious careers. When asked for advice, it could go up or it could go down. Uh, you know what? Maybe as one of our partners said, maybe the EIA has finally capitulated.
After a couple of years of rough going.
Right after a couple of years, seeing the markets go to to negative and then 120, 130,
Well,
they've they've come they've come down to the very simple realization of how to forecast price.
they did fail to include one other possibility that the price remains the same. So that's not
That's true.
right,
I think in these
the
in the
naive
markets we've
forecast.
seen, that's a tail risk, I guess, these days.
Yes, yeah,
That's the surprise.
that's a good point. It's a yep, unchanged. Anyway, Andy, let's get into this. I think what's standing out in the news and so much commentary on is this price cap for Russian oil. Can you just give us a background on where Russian oil supplies stand now? Talk a little bit about the price cap idea that's expected to take place soon, and where you see Russian oil supplies going forward.
Well, the that that's a lot that's, that's a lot to present, but well, I'll give it a shot. I think one thing that you could look at, and this kind of supports what the EIA said, is not only expectations of future Russian production, but even current Russian production. The numbers from the EIA, OPEC, and the IEA are all over the place, not surprisingly. And looking at where we think Russian production is right now, before the invasion, it was including condensates was probably around 11.3 million barrels a day, which most of the agencies agree on. We think right now it's down probably six or 700,000 barrels a day to 10.6 million barrels a day of production going forward. And herein lies the different views of of the market. OPEC, the OPEC agency, has Russian production in October going down to or at 10.2, And then in the first quarter of next year, they have 10.1 and then right around 10.2 for the rest of the year. The EIA has Russian production going down to 9.3. So, there right there, there's an 800,000 barrel a day difference. We think it's going to be around 9.7 as a guess, which would be down around 1.5 million barrels a day, let's say pre invasion. But as this, to say the least, is a high degree of variability around where where Russian production may end up in 2023. As we head into the fourth quarter and into 2023. We do believe it's certainly going to go lower as the embargo starts on December 5th, and this price cap idea posed by the EU, also looks like it's going to begin on December 5th, maybe. That we're still waiting for the details on the Russian price cap from the EU. Some of the numbers floating around are capped, the Russian crude capped at $50, which to me is really low. The market itself is 25 under where Brent is. So the market itself is a good $10 or $15 above what the EU is talking about. And the US, of course, is involved in the price cap discussion. And the Russians have said that under the price cap, that what they're going to do is just simply not sell crude and back into production. The US thinks that might be a bluff, because once Russian production is back, then it's difficult to restart some of these older fields. So
Right.
it'll be really interesting to see. Obviously interesting. It'll be critical to see where these numbers end up. Where they end up falling out, and exactly what happens. Again, we're pretty good at barrel counting. And what I think in terms of exports that are going to be affected out of Russia, I think it's going to be somewhere between 1.2 to 1.3 million barrels a day, taking into account that from pipeline, from the Friendship pipeline, as well as seaborne exports to Europe, as well as possibly Asia. And be interested, again, it would be critical to see whether Russia is going to be able to re you know r- replace those exports, as well as is Europe going to be able to replace Russian exports, because they're still, they've cut down on where they were pre-invasion, but they're still 50% of where they had been.
Yeah, it's interesting. You want to punish, you want a policy that punishes Russia, and one way to do that is to not have the world buy their oil, but you also punish yourself by jacking up oil prices. And when I listen to that Deputy Treasury Secretary Wiley, his last name, talk about the plan, it's to keep oil flowing and keep oil prices down so you don't hurt the world economy with higher prices. And when you think about when OPEC and oil producers come under stress, obviously it's when prices are lower, not when they're higher. So any policy that keeps you kind of in a weird way, you want Russian oil to be flowing. I mean, you want people buying it, so you just would like them to get at a big discount. As you mentioned, the discount's already $24 under Brent, but if Brent goes up 10, 15, $20, $24 below that is still a good number. So they want to get an absolute number out there. And the way I understand it is they don't really expect Russia to sell oil at that price, but they would expect buyers of Russian oil to negotiate from that price. So they may pay a little bit more than that. But as all of these well-intended schemes, they get jobbed, they get gamed, and there's unintended consequences. And you can see sort of, I don't know, maybe a little crack already where OPEC is talking about maybe the U.S. is in Europe are creating a buyer's cartel, and maybe this plan is not just to target Russia, but eventually the Saudis, because we're obviously not getting along with our old time friends like we used to. So it'll be interesting to see, and certainly puts a lot of uncertainty. And I think you're right about the basic thing is you want the trade patterns to adjust. So Europe buys from someone else and Russia sells to someone else. But are there enough buyers? Like, can India and China take more Russian oil?
Well, they probably could. I think in China's case, it's a question of whether or not they would. China's always preached the diversity of supply, and whether or not they want to keep Russia moving up their supplier charts, moving up the tables.
Yeah.
That obviously is going to be part of policy. I mean, they could theoretically take take more, either at the expense of somebody else, or as from another supplier, or put it into storage, and they have been building more strategic storage so far over the last 4 or 5 years. But that remains to be seen. The other thing is there's no, it would have to go, the voyage, it would be seaborne. The pipeline can't take any more barrels. The Russian Chinese pipelines can't really. There's no capacity to take more. So
I wonder what the name of that pipeline is. If the one going into Europe is the Friendship Pipeline, I don't wonder what that is.
Yeah, it does have a name. I can't. It's
Yeah.
not coming up to and that is supposed to be expanded, but right now it doesn't look that way. I mean, right now it isn't.
Ha-
India is interesting in that there've been stories that Indian refiners want to take more Russian, and stories that Indian refiners are going to take less Russian. For India, the big the prize is for the refiners to produce more gas oil and middle distillates, which are in the northern hemisphere, and particularly in the Atlantic basin. Distillates are diesel's short, really, very short. So if you could get more Urals and produce more diesel, that's tremendous. So if I was a Indian refiner, I would want all the Urals I could possibly get. But that to a certain extent is also going to be a government decision. So it isn't as though all of a sudden Russia's going to be able to take those million barrels a day and move them to China or India, which is why I suspect that their production is going to have to decrease.
Yeah, it's interesting to me that I know these numbers. It's a market economy, but if China and Russia are sort of allies, best friends forever, whatever you want to call them, they're buying their oil at a very deep discount. So how does that conversation go? I mean, it's India too. It's like, yeah, we'll buy your oil, but not at a normal discount. We want a deep discount. I mean, I'm just trying to figure out how that number gets set. Is it,
Well, I
you know,
guess they'll have the fixed price to negotiate against.
Yeah.
It's whether or not the Russian government decides to sell it at that price, or
Right.
just walks and says, look, that's based on a fixed price, and we're not gonna, you'll have to pay up. I guess it'll be a negotiation or not.
So I think I'm really I wish we had another way of saying winter is coming. I see it everywhere. I say it's not funny, it's not clever anymore. It's like cliche, but where is it showing up in the market, Andy, that there is after December 5th, 1 million barrels might be off the market. I mean, it's a perfect buy call strategy, or maybe you buy futures ahead of time. It, is it already in the? Just don't. I'm not sitting on a desk, so I don't see the paper flow all the time. But I just don't. I follow it. I don't see the constant. I don't see the fear out there of this happening. Although implied vols are hanging around 50, so that's kind of a high number. But I don't see the trades coming through that would suggest we have a serious problem ahead with some barrels possibly being taken off the marketplace or another disruption in the flow. What do you say to that?
Well, I think there's also the countervailing flow of the recession play, right? Some of the macro hedge funds that have been selling crude as a proxy. I mean, maybe they covered over the last as a proxy for a poor economy. So maybe that's one of the reasons why there's maybe less stress in the market, but there is stress in the market. All you have to do is look at the diesel market,
Good point.
uh,
Yep.
right? I mean, the diesel
Yes.
market here, this week in New York Harbor, or end of last week, this week, it's trading 75 cents over the screen.
Hmm.
And there's a shortage in New England and Central Atlantic states. I mean, we are running about 50% of normal. Central Atlantic had a couple of builds here, but it's way too low for this time of year. In fact, looking at up looking at the build, we should be building inventories this year. We should be building inventory seasonally through, September and into October, and we're just not. In fact, if you looked at Central Atlantic and New England states, I don't think it's been this low since 1951. So, it's like a historical low on inventory.
So,
So we're seeing that in the cash market. Europe too is stressed as well, because Russian diesel is about to, by February there'll be no Russian diesel go, which is a big Russian gas, oil, and diesel. Russia was a big supplier to Europe for diesel. So Europe too is really tight. And then you probably have some fuel switching. I don't think it's going to be diesel though for natural gas. I think that would be like the last petroleum, but it depends on your plant.
right.
So I think the stress is there. The market is backwardated, right? It's not crazy backwardated, but it's still, actually Europe is well over $1.50 backwardated, less so here in the US. So, I think that's where, and the cracks, Jim, oh my God, the nearby the nearby diesel crack traded like $85.
Mm,
And gasoline too, the cracks are pretty, the cracks are really healthy. So, refinery margins are good. Refiners haven't been, we're still in maintenance season. So, at least here, margins in Europe are good. Here they're good. In Asia, they're not. So one would expect that, from China and India, we'll be getting, there is spare refinery capacity. So we should be getting exports to help with the problem. But, it's a big problem. And that hopefully it's not a cold winter.
yeah, I know. That's what we're hoping and praying for. it's interesting. I last year I had a problem with Ida put some water in our basement, destroyed our oil burner, so we had to get it replaced. And the next progression would be to put natural gas in there. And there's a moratorium in New York on that. You can't put natural gas burners in your house until I think next year or something. So we ended up getting a heat pump, and it's amazing how much lower my heating bill was last year, but this year it's going to catch up because the electricity prices have gone up as well. Won't be as high as heating oil, but yeah, I mean, there's in our area, there's a lot of natural gas still in the northern areas. A lot of heating oil still used for heat, and we restricted natural gas pipelines here. So anytime there's a cold snap, the price of gas soars as you would expect, and everybody goes crazy. Anyway, let's I just want to talk about we talk about uncertainty and supply, uncertainty and demand, and one area where it's showing up is in option volatility. We can't seem to keep get vols down to more average levels in the 30s. It's been staying up in the 40s and hovering around 50%. So clearly there's something going on, and you just mentioned a whole bunch of things. But what's interesting, what's dominating the option flow are these $1 wide strikes, call spreads. So to give you an example, I looked at the open interest numbers in oil WTI options, and in February of 2023, the 119 and 120 calls have about 75,000 open interest, and that's a huge number. The June 120, 121 calls has 75,000. And this is yesterday, a $1 wide call spread traded 114, 115, 25,000 times. And these things are settling around 3, 4, 5, 7 cents around that level. So this has been going on through this crisis, and even a little before. And these seem to be not talking to the person who put the trade on. I don't know for sure, but talking to other people, there seems to be a consensus that these are hedges against digital options. And digital option would be if the price is up around at a certain price, when at expiration you get a cash payment. You don't exercise into futures contracts and eventually get barrels if you want. You get a cash payment, and that's how it's settled. And these $1 wide strike prices would be hedges, dealers hedging against hedging the other side of those. So yeah, so maybe that's what's going on with these crazy markets, and the basic textbook hedge of I have production in the future that I want to hedge. I'm going to sell futures because that price makes sense to me. You have to be careful how much you hedge out there, even if you love the price, because of the cash flow implications. You have a mismatched cash flow. If prices go up sharply today, you got to come up with margin money. And so the best strategy around that is to buy puts, obviously. But if you do have hedges out there, maybe it is making sense to do some kind of call protection on the upside. Not sure. I'm not sure who. There's probably a hedge fund doing this stuff, but it could be somebody hedging against higher oil prices as well. I just think there are better ways to do it than digital options, but that's just my opinion. And then the other thing I'd say, our old friend, the Dees $2,200 call that we were following for a couple of years now. It was the number one open interest option for a while with above 60,000 open. It's now moved down to 8th place. It's 41,000 left, and obviously it's going to go off the board in a month. So yeah. What else? Yeah, that's about it. I don't know. So that's the only sort of, if you take those trades out of there, that option volume has been not too impressive. Having trouble getting over 100,000 a day. That's in WTI. So
Well,
Anyway,
that may be part and parcel of the slowdown in trading period, right?
yeah,
The lower open interest, lower volumes. I think volumes are coming up a bit, but they're certainly not where they were pre-invasion, and probably nowhere near where they were pre-COVID.
yeah, I think this is happening across all markets where it's harder and harder to predict. I mean, just look at the Fed, how poorly they. I mean, these people have the best information, smartest minds, and how poorly they do forecasting what's going to happen, and they're making policy off of that. I think, I've been banging the drum about considering the standard deviation issue. If you tell me that you can supply hydropower to me over the next 20 years, and climate change is going to actually increase that hydropower, so I can rely on that. I want to know what's the standard deviation. How many of those years are your your rivers going to be dry? Because that's what's important. And we even in price projections, we do it, and I think you do a great job of cautioning people with saying, anything can happen. You've done that for years because these are crazy commodity markets, and the crazy people that trade them. But we really need. It's not just picking up a price and saying this is 6 months. We expect the price to be here. What's the price path that it gets there? I mean, we've seen bullish views ahead of. I think we had a $20 drop when China went back into lockdown, and people still remain bullish, which is fine. But if you're trading these markets, you're long gone from that bullish view. Otherwise, you won't have a job. And so it's totally different putting a price out there and being able to hang with that view than in the real world when you're trying to either trade or make hedging decisions or even policy based on a view that may be right in the long term, but in the meantime, it takes this major move in the opposite direction. So, yeah,
Yeah, you can't sustain your view or your trade. You were talking about the margin money that you might have to put up on a mismatched trade.
yeah,
And, I think certainly the European natural gas companies learned that. And recently, some of the pension funds in the UK certainly learned that it could be very costly to put some of these hedges on, particularly when the markets do go into a tail risk type move.
yeah. I don't want to pick on anybody in particular, but this paper came across my email, and it's something about a world equilibrium model of the oil market, and you go, you said what? How long have we been following this market? Would you ever say it was in equilibrium? And maybe for a couple of months, but not too long. And
Yeah, I mean, it's right. I mean, the market could trade sideways for a while, and yeah, it actually does get into equilibrium, Jim. I think there have been periods during the last 30 or 40 years where it has been, it's been boring. I mean, it has been equal. It has sort of been
it
an
seemed that
equilibrium.
way. Okay, I'll give you that.
Yeah,
Yeah.
and but then it invariably will break out, and one way or the other.
Yeah, well,
And
I mean, the paper was written in 2017, and then it was revised in 2021. I think they kept the same title after, oil prices went negative. I said, okay,
all right.
yeah. Anyway,
Well,
getting
I did
snarky
want
here.
to talk. I mean, we talked about Russia, perhaps losing, with over 1 million barrels a day, or the market losing over 1 million barrels a day from Russia. And then we have our friends in OPEC, who, along with the Russians at that last meeting, somehow decided they thought it would be a good idea to reduce their production into December, and then into next year by what they said was 2 million, but in reality is probably going to be under a million barrels a day. So we are going to lose production from Saudi, the UAE, Kuwait, some. Iraq is sort of balking, so I'm not sure how much is gonna come out of Iraq. So, we're working with about 800 to a million barrels a day on an OPEC reduction. It could be less than that, Jim, but certainly from a political standpoint, that move didn't endear the Saudis to the U.S. administration, and indeed, President Biden just released another 500,000 barrels a day, basically in December, which I think has will serve to make up some of the losses, and we'll see what happens in first quarter. The SPR is due to release virtually nothing, but he said that they may continue to release into the first quarter. So I think taking into account the production loss, the production losses, and we're talking about a lot of uncertainty around the numbers, as I mentioned. You also, we're also trying to figure out whether demand, on, where we going on the demand side, and certainly there's been some benchmark revisions on demand, and the IEA and the EIA both went down like 500,000 barrels a day for next year, and then fourth quarter they've revised demand downward because of economic concerns. We still, even with these losses in on production, we still show in fourth quarter, because you had such there was a huge. I mean, OPEC was really producing in September. They were close to 30 million barrels a day. I mean, they were really cranking it out. So September and October are going to be pretty high, and November too. Then the December will reduce. But in any event, taking it all, putting it all together,
Yes.
we still are showing a slight surplus for fourth quarter. But most of that again is because of the October numbers, and as well as we're still getting a pretty good dose of SPR barrels, and we've marked down Chinese demand a little bit more, and U.S. demand, as we've been mentioning on these podcasts. It's not like booming. I have a hard time coming up with the adjective.
Right.
I mean, to me, relative to expectations, it's pretty disappointing.
Right.
Even from mid-year, I think it's pretty disappointing. So,
It's going to be overall. It's going to be down year over year in the
no,
U.S.
it'll still be up. Gasoline is probably going to be, I don't know, unchanged, distillate unchanged. I mean, maybe a little higher on both. I mean, distillate and jet has grown this year.
Jets up. Yeah.
Diesel has been the winter was. I mean, diesel did okay in last winter. Gasoline, I think, is going to end up being unchanged to last year. But it's really fallen off the table since July, and that has to be a price effect. Gasoline demand has been really disappointing since July.
Hmm. So you have stocks continuing to build throughout this year. What about next year?
Next year looks balanced. I mean, really balanced. I mean, we have slight surpluses every quarter, but it could easily be deficits, Jim.
Right.
It could be deficits. So to me, that is, I'd have to say that's probably more bullish than bearish. I'm not sure where, like, all the supply is going to come from, if we actually need it. U.S. production has been disappointing this year. next year it should grow. And there should be, you look at the EIA. I'm going to tell you something, Jim. Yeah, that you will. I know what you're going to say. The,
I'm
the
not going to
the
say it.
big the big gains, for next year are supposed to be from the U.S. Europe. It looks like Europe, maybe, maybe some North Sea gains, and Brazil, Canada too, and Brazil.
Okay.
Brazil, right?
Yep.
Brazil's supposed to come up with a big, a big increase.
Yes. All
And
right.
I think you got to put a, as usual, put a question mark hopefully they come through.
Yeah. And Trinidad and Tobago.
And Trinidad and Tobago,
Yeah.
Guyana, Guyana. Well, Guyana probably will, will
Guyana.
have a nice increase.
Right. Right.
And then on the demand side, obviously, how cold the winter is going to be for next year, and what's going to happen with will there be a recession? Will it be a deep recession? Will it be a shallow recession? Is there going to be no recession? And that could obviously switch things over. So next year looks real. It looks another interesting year coming up.
Yeah, it's interesting. You hear recession a lot in the news, reading it on the financial news stations, and when you watch something like the Atlanta Fed's nowcast, it keeps going up. I think it's up to like 2.7% for that's for the current for the that would be the third quarter GDP. So I hear it, but and then you look at the JOLTS numbers. There's a heck of a lot more jobs open, looking for work, uh, businesses looking for workers. And so it's, I know people are saying that interest rates are going to tamper, and all these economic projections have come down for the world. I think Oxford went from what, I forget, from 2.7 to 2.22, something like that. It was a big reduction down, revision downwards. And, but I don't know, it's kind of 2.5% growth. I mean, Atlanta's not always right, but they don't have any. It's not like it's somebody's bias in there. These are purely off the numbers. But I don't know. That recession thing, we'll have to see.
Yeah, we'll
Um,
have to see. I mean, these earnings are coming in, and a lot of the chat has been, you know what? Business is okay. It's
it's
pretty
not as
good.
bad. Yeah,
Yeah,
at least in the
pretty good.
U.S. Yeah, yeah,
In the US, yeah.
yeah.
Europe is a whole different story, and I'm sure next year's could be very brutal in the developing world. And China too is still, they're still pursuing the zero COVID, which puts a cloud over where their demand is gonna be. I think it should grow next year. It looks like this year, Chinese demand is gonna not grow, which is, extraordinary.
Shocking.
Um, and next year, I think I have it growing, but, you know, who knows?
So
I'm not
yeah,
I'm not sure,
yeah.
right?
Well, I remember going into COVID 2020, you were doing spin moves and trying to count barrels, but you did
Yeah,
it.
right.
You,
That
you,
was
but we had a couple of podcasts back there where the big three, OPEC, the IEA, the EIA, came out with demand numbers, and you just said, yeah, you used something stronger than nonsense. I forget what it was.
yeah,
You've
I
done
think I did, but
you've
right.
done a good job with the demands. I think you were less optimistic than the rest of the crew there, and yeah, that was good. But I've asked you this before, and you hate this question, but what's your desert island indicator for oil markets? Like, if you were, what would you want to see if you were stuck on an island and you could get one data point? What would it be? It doesn't make sense in this
Well,
market, right?
yeah, that is a tough question. I think I guess it would be Russian exports.
Okay,
What are the Russian exports and Russian production? They go hand in hand. I think those are, that's probably, uh, uh, the one data point that if I had that, that would be a good, that would be something,
Yeah,
a real key.
that'll tell you a lot.
Yeah, that would tell you a lot.
Yeah, yeah. And so do you want to talk about prices or do you want
Yeah,
to?
I do want to talk about price because one thing that I think is going to happen as we head closer to December, it's probably happening already, but as we head closer to December 5th and into the winter, as Russia tries to figure out where these barrels are going to go, or what to do, and the price cap is either imposed or not imposed. The sanctions will happen. That's a given. I
Mhm.
think there's going to be a lot of dislocation.
Right.
And generally dislocation is bullish for markets, at least for the curve. You
Bullish
know,
for
on the
VTOL too.
Yeah, yeah, right. For all those, and they're looking, they're all looking for storage,
Right.
so which is pretty interesting. In that, right? So I don't. It's hard to see a path towards much lower prices, unless the winter is unbelievably mild. So I think the lower end of these, I think WTI's low is 76, but even, 80 or just below 80, I think ought to hold. And
Mhm.
on the upside, I think for WTI anyway, could the market get back to 90? Yeah, I think it could pretty easily get back to 90, given what we've talked about on the bullish end of the ledger. Possibly a little higher if things get really tied up in knots. And so that's kind of what I, what
Who you're working with?
what I'm working with. Yeah.
But you're not seeing something crazy like $150. Not crazy, that's attainable. We've almost been there. But 150 in the wintertime, you don't see that?
Unless it's, well, could it get to 150? Yeah, I guess if it's really cold, like a brutal, brutal winter, and we lose. Here's another key thing to watch. If there's another oil, something happens where there's a disruption in a place that you don't expect.
Right.
Uh, for instance, what's really what you don't hear a lot, but Libya has was so important to trading this year, because we lost, like, there was a loss of 600,000, 700,000 barrels a day.
Right.
And that was really important for the market, particularly because that's light sweet crude that goes right into Europe.
Right.
And Libyan production came back, and that was a major bearish factor. And it was one of the factors that took the market, well, not the factor, but so
Contributed.
let's say Libya, goes down, or Nigeria, something like that, where a major supplier goes down.
Yep.
Yeah, you could see the market.
There's no cushion.
That's it. Yeah, there's no cushion,
Yeah.
and the SPR is being drained. There's not a lot of spare capacity. Yeah, there's no cushion. That's exactly right, Jim.
Yeah,
There's
no
no
margin
cushion.
for error. Yep. So
Unless these prices then, if we do spike, and then the recession is really,
right.
much harder.
Yep. So volatility will remain in this marketplace.
Looks that way.
Yeah. Okay, Andy. Anything else that I'm sure we missed a lot, but what
We
anything
definitely
else?
missed a lot because there's a lot going on. But I think we covered a lot of ground. And if you have more questions, as Jim said, you can find us at commodityresearchgroup.com, and you can find me at either on LinkedIn, or my email is alebow at commodityresearchgroup.com. That's Lebow.
Great. Thanks, Andy. Catch you next month.
All right. Thanks, Jim.